An honor to be here and to speak with you all and just kind of share what's going on in the interest rate market, the mortgage market, then of course, the real estate market as well. And I'm going to share kind of what we're seeing in those three different categories. And we'll start off first where rates have been and kind of where rates are headed. Rates hit an 30-year mortgage rates hit an all-time low of 2.65 during 2021, kind of at the height of the pandemic. And as we stand today, we have 65% of homeowners have an interest rate with either a 4 or a 3 or a 2 in front of it. So a majority of homeowners have been able to take advantage of lower interest rates either by refinancing or by buying a new home in the last couple of years. And this is kind of across the country. So we're seeing we've seen a significant rise in interest rates here in the last year. The Fed is, printed a lot of money with the pandemic, and there's a lot of supply chain issues, which causes prices to go up and, really caused some inflationary pressure. And when we have a lot of inflation, then the Fed has the tool to increase short-term interest rates. Now, there's a tremendous difference between short-term interest rates and mortgage rates. Short-term interest rates have risen kind of a record amount in the last year. From we measure by the prime rate because that's what affects us as consumers the most, which was 3.25%, and it's now 8%, probably on its way up to 8.25%, maybe even 8.5% over the next few months. And again, the Fed is using that as a tool to fight inflation, keep prices down for all of us, so we don't end up paying $6, $7, $8 for a gallon of gas and $6 for a gallon of milk. And they've done a good job of that because gas prices have come down and milk prices have come down. Those rates, short-term rates, affect us directly in the lines of credit that we might have on our house, in the credit card balances that we may keep on a credit card, or even car loans. 2 years ago were 2% or 1.99. Now the lowest rates are 4.5%. So it affects those kind of consumer borrowings that you may or may not have. It doesn't.
Scott, can I just ask you some questions as we go along, so that
Sure.
some questions that maybe some people are thinking about and just don't want to answer or ask the question. You mentioned the Fed funds rate, which is what the Federal Reserve controls, and the prime rate, which is directly affected by Fed funds. Can you talk a little bit about mortgage rates? Because obviously they're not they don't follow lockstep what Fed funds do. What do mortgage rates tend to follow more?
So the mortgage rates are closely aligned with the 10-year Treasury bill. And the 10-year Treasury bill is affected by the market. Well, I should say the Fed has a lever that they can change the overnight lending rate or the prime rate by just saying, okay, we're going to change it. They cannot change the 10-year Treasury bill because it's a traded it's a T-bill that traders trade. So the 10-year Treasury is affected by what's going on in the economy. It moves ahead of what the market thinks the Fed is going to do. So if they think the Fed is going to raise interest rates a significant amount, then the traders will trade that Treasury bill into a higher yield. Hence, therefore, increasing mortgage rates will increase based on what that yield is for the 10-year Treasury. Now, for some,
the Fed can't directly control mortgage rates or raise mortgage rates. Indirectly, by raising Fed funds, they can cause either more supply or more demand in the 10-year Treasury note market, therefore driving interest rates.
Precisely, exactly right.
Okay.
Exactly right. So at the moment, we have what's called an inverted yield curve. So for those of you who are retired and you have CDs, well, for the last 10 years, the CD was paying like 1% or 1.5% or 2%. Well, now all of a sudden you can actually get a 6-month T-bill or a 6-month CD at 4.5%, even up to 5%. I've seen them. And a 10-year Treasury, if you want to buy a 10-year Treasury bill, which is money's locked in for 10 years, today that was 3.4, which is significantly lower than a 6-month CD or a 6-month T-bill. So you've got that's where you've got an inverted yield curve, so they can control money, like Ryan said, by making short-term money more attractive than long-term money. And then eventually, long-term money has always been typically in a normal market, it's a higher paying, more reliable source of income over a longer period of time than a overnight lending rate or a short-term T-bill or a 6-month CD. So that is the inverted yield curve, which we're experiencing now, has been a reliable sign in the past and a predictor of some kind of an economic recession. I'm not an economist, so I can't say that's 100%, but the past history tells us that things have to equalize at some point, because who's going to lock their money up for 10 years if they can get more money by locking up for 6 months? And
the old saying in our industry is that the inverted yield curve has predicted the last 8 out of 6 recessions.
8 out of 6, that's pretty good.
Yeah. So it's a very reliable indicator, but it's not 100%.
100%, yeah. So we're currently doing mortgages, and we're seeing lines of credit. I've got lines of credit. People are 8 to 12.5%. Mortgages, our first mortgages, we're booking those loans in the mid-5s to mid-6s, depending on the type of loan that you have. And people are like, "Oh my God, that's so high." And when you look back and say, "Well, what's the average interest rate been over the last 40 years?" It's actually been, for 30-year fixed, 7.75%. So mid-5s, 6s is not terrible. And some of y'all who owned houses back in the 80s, or bought houses back in the 80s, you were paying 10, 12, even 14% on the first mortgage that you got. I hear this quite often. So when I hear youngsters complaining, "Oh my God, the rates are so high at 6%. I'm like, "Hey, you should talk to your parents or your grandparents and ask them what they paid." and then they get.
Do you feel like the higher, from what you're seeing, and I know you're not on the real estate side as much, but obviously you see the prices and what people are purchasing. Do you feel that these higher rates are going to adversely affect real estate prices, or at least slow their trajectory down? And what are you seeing in the different I know you're mostly North County, but what are you seeing in the little pockets as far as your buyers and sellers and what it's doing to underlying housing prices?
So we're seeing a slowdown we had a massive price increase through the pandemic just because of the demand was so great. There was lots of extra money in the market. The interest rates were super low, so we had a huge price run up. So now what we are seeing, yes, what you just said is completely accurate. We're seeing a slowdown in prices going up, or in fact, from the height last July, which is kind of the tippy top of the market, we've seen a settling of pricing in the market, wherein prices are not houses are not selling for as much as they were back then in certain pockets and micro markets. Certainly by the coast, you have high demand, low supply. Well, all over San Diego County, you have high demand and low supply. So you've still got a lot of, unfortunately, you've got a lot of price pressure, which I'll get to in the third section give you my real estate market update. But we're seeing at the moment, still a large demand for housing, low inventory. We're doing all types of loans for all types of homeowners. People that had a client who bought a $9 million house. He has a ranch in Alpine. He's got horses. He's driving an hour. His wife's driving an hour 5 days a week to go tend to the horses. So he bought a horse property in Encinitas where he could have his horses here. So it was $9 million. He borrowed a couple $1 million, and it's going to be great for him because now his wife's not have to drive an hour a day to take care of the horses. We're qualifying first-time buyers, talking to a lot of first-time buyers, and I'm feeling in a lot of cases those buyers are a little bit priced out of the market. They're not making enough money to afford a home that they are comfortable or want to live in compared to where they're living now. They might be renting. I have a client renting in UTC area, and she pays $3,000 a month in rent. And for her to afford buy a home in that area for 2 bedrooms for her and her child, it's going to be about $650, and she probably can't afford that. It's just a little bit too much. We're seeing other clients move up in value. We've got a client who's a veteran. He bought a house 3.5 years ago, condo down in Point Loma for 300,000. He's selling it for 500. He's tired of living in a little kind of a 2-bedroom condo, tight quarters, and he wants to get a house. And so he's going to sell his condo and buy a 750,000 house more out in East County and get away from the coast. So he has more room, more space. So we're seeing all kinds of different people come in. I've got another buyer, or this was very common during the pandemic, and even still is. We've got a lot of people in the tech industry that can now work remotely, and those people have discovered San Diego. They live in the Bay Area. They lived in the Bay Area. Their bosses said, "Hey, you guys are in tech business. You can live wherever you want." So they moved to San Diego about 9 months ago. They have a child now, and they've been renting a 2-bedroom, 2-bath apartment. They're like, "Wow, we're bursting out of this place." They want to buy a house, and so they're originally from Chicago, and they're just like, "This is San Diego's awesome. We love it. It's great to be here, and want to buy here and set roots down here, and we can work remotely and travel all over the place from here." So we're seeing a lot of that going on. We've got again always people looking to build wealth in real estate. We got a doctor looking at buying an Airbnb down in PB that has a good history of making $270,000 in income a year. It's a $2 million house, and he wants to own some real estate, diversify his portfolio. So he's looking at buying a property to do that. We're getting a lot of inquiries for people that need money as well, that are staying in their homes and they want to put new windows in. They want to put 2 floors, carpet, paint, or even we did a workshop on an ADU. An ADU stands for an accessory dwelling unit, which you can also add to your. You can convert your garage. You can add a new structure in your backyard if you have space. So we're doing a lot of home equity lines of credit for stuff like that, and even done a couple of debt consolidation loans where had some clients who had 40-50K of credit card debt. It was costing them $1,500-$1,600 a month just to maintain that debt. And we got a new first mortgage for them, which they were paying 4%. We took them up to 5 3/4, but consolidated all their debt and lowered their payments overall by $700 a month. So they were greatly relieved by that. And lastly, we talk to at least one person every week who's over 62 years old. They're retired. They have a house with a ton of equity in their home, and they're worried they're going to outlive their money. So they're running out of money. They don't have huge incomes, Social Security, maybe a small pension. So we're talking to them about reverse mortgages, where reverse mortgage gives you access to the equity in your home, and it eliminates your mortgage payments. So you don't have to make a mortgage payment, for the rest of your life. You can live in the home for the rest of your life as long as you live there as your primary residence. So we're talking, those are all the different types of mortgages we're doing right now. And it's been.
Can you talk a little bit about the difference between a fixed rate mortgage and adjustable rate mortgages, so folks out there understand the differences between the two and what the qualifications are and how they affect cash flow and what have you?
Yes, absolutely. So a fixed rate mortgage is, what if you're an older generation, the next generation, baby boomer generation, you were taught and told, hey, you got to get a fixed rate mortgage. You got to pay it off so your house is free and clear. You don't have any debt, so on and so forth. In the last 25 years or so, the mortgage market is very creative. The banks want to keep business moving, so they've come up with additional products to help people kind of customize their loan scenarios and customize their payment plans so that they can, maybe not get a fixed rate mortgage and pay a little bit less per month. So that came in the form of a 5-year or a 7-year or 10-year ARM. An ARM stands for adjustable rate mortgage. And on those adjustables, you have a rate that's maybe fixed for 5, or maybe fixed for 7, or maybe fixed for 10 years. And at the end of that period, the rate's going to change, or it's going to adjust. And it could go up, it could go down. It depends what the market is at that time. And those rates are typically a little bit lower than what a 30-year fixed rate would be. So if in your heart of hearts, Scott, Marie, my wife, we know we're going to live in our house for the next, 7 years at the most, then we might take a 10-1 ARM, knowing that we can save a couple $100 a month versus doing a fixed rate, because we know we're not going to get to the end of the 10 years. We're not going to get to the end of the runway and be subject to any changes of that particular loan or the payment going up or the rate going up, et cetera, et cetera. So in the meantime, we can save that couple $100. We can use that to invest it. You can use it to pay down the mortgage faster. There's a lot of ways you can do to make your money work for you. Did you do that, Chris? I see you raising your hands. Yeah. So that's really an ARM product. And at the very moment, the ARM product and the fixed products are not all that different because the ARMs are closely tied to the shorter term T-bills, like a 5-year T-bill or a 2-year T-bill. And a fixed rate is closely tied to a 10-year treasury. And the 2-year T-bill right now is 4%, and the 10-year T-bill is 3.4%. So the ARMs in a lot of cases are similar, or if anything, slightly better than a fixed rate. So we're booking mostly 30-year fixed rates in today's market because of that. Now, you asked me 2 years ago, I got somebody an ARM at 2%, the 10-year ARM at 2%, and the fixed rates were at 2.5%. So like, let me take it. I want to have 2%. I love the idea that I can have a 2% loan. And I know I'm not going to be here 10 years or keep the loan 10 years. So they save 0.5% for however many years they end up keeping the loan. So there's definitely advantages to it. It's just not a prevalent product in the current market. So.
All right, Scott, so you talked about interest rates and mortgage market. Do you want to give us a local San Diego real estate market update here? So
Would love to.
You know, something that's not national, more idiosyncratic to the San Diego area.
Yeah. So what we're seeing in this market in San Diego and across the country too, but prices peaked kind of last July. So that was the very peak of the market. The Fed started raising rates last March. And as soon as they started raising rates, the mortgage rates jumped from 3% to 3.75 within a few days. And another month later, they jumped from 3.75 all the way to 5. And that significantly slowed down the velocity of sales in the market. And also people started saying, okay, I got to buy these houses before the rates go up. And so it created this kind of, I call it artificial price appreciation for about 3 or 4 months last year that took prices up. You know, in San Diego, took prices up, 20% within 4 months, which is an unrealistic amount. Which is why we're seeing price decline or price. I would say call it price settling in today's market. Fannie Mae chief economist predicted a 4% decline in values for this year. He just revised it yesterday to a 1.2% decline in value across the country. They also predicted sales of 4.2 million nationwide, which is the lowest amount of sales across the country since 2010. And we've seen, like I said, definitely a price settling in the market here in San Diego County in the last, since kind of last fall, August, September, started to slow down. And it's been very, very slow since then. And not slow because there's not people who want to buy, but slow because there's no inventory. So what we feel like this is happening in San Diego is that people, like I said, 65% of the people have a super low interest rate. And when you look at normal transitory sales and people moving, they're like, if you're you're looking at retiring and moving down or downsizing. When you look at that and you say, wow, if I sell my house to get the money I need out of my house and I go buy a new one and borrow some money, I'm not saving any money because I have a 2.5% right now, and now I got to pay 6%. And I love my house, and it just doesn't make any sense. So because of that, we have very, very low inventory, specifically in San Diego, but also across the country. And when you have low inventory, it's tough to get, you can't get any market move or anything in the market to move. Now, the inventory is selling very quickly. We're seeing multiple offers. We're seeing overbids on properties that are selling. There was one last week. There was a house listed in Lakeside, California for $899. The highest sale had been $900 in the area. Someone paid $1.45 million for the house. Now, at the end of the story, there was 14 offers. There were 60 people that came to the open house. They had 14 offers within 3 days of setting the open house up. End of the story is that the appraisal came in at $950, and the buyer and the seller split the difference. So the seller ended up buying the house for $1 million as opposed to $1.045 million. They came to a kind of meeting of the minds, and and worked it out. But we're seeing that.
And you said that's in
common.
Lakeside. That's
I was in
north
Lakeside.
of El Cajon, right?
Yeah, Lakeside.
That's north of El Cajon, south of Ramona area, I
You
believe.
got it. You got it.
Okay.
Yeah. And we're seeing that across the county. I have a client who just paid, $5,000 more than the list price for a little 1-bedroom condo in Carlsbad. We had a couple other clients who paid as much as $200-300 over the value in a Carmel Valley house. Another one in Encinitas that was listed at 2.1, sold for over 2.5 million. They're in escrow now, and we've just seen a lot of the houses that are coming on the market is they're getting a lot of traffic. I had another client who's moving up in value or moving up in size because they have a family and they're bursting out of their house. So they're selling their house for 1.8. They had 100 people come through their house this past weekend. They've already bought a new house subject to the sale of their house. This is in Santa Luz area and Torrey, just before you get to Santa Luz and Torrey Hills area. Torrey Hills area. And there's things are moving. The issue is that there's not enough houses being listed for sale. Normally in San Diego County, there's about 5,500 transactions a month. And the last 3 or 4 months in a row, the average has been about 2,200 transactions. And that's because there's just a lack of inventory and people are not motivated to sell because it's going to cost them more money unless they're leaving the state. It's hard to motivate to sell your house if you're going to have to pay more than you're paying now. So they're looking at it twice. They're circling back, doing it, maybe saying, okay, well, let's stay here. Let's fix let's paint, let's carpet, let's do new floors. Let's do some upgrades instead. So bottom line is, last time I checked, San Diego is pretty nice. I know y'all live here. And when you compare it to LA or the Bay Area, Orange County, as you go up the coast, the traffic pattern's better, the quality of life is better, the weather's better, it's warmer, it rains less. And the secret's out, people know about that, So I would tell you what's in store for our market in San Diego, especially on the coast. I had Gary London out, who's one of the leading real estate economists in San Diego for the last 35, 40 years. He helped all the developers build high rises downtown, all the developers build out all of Rancho Mirado, Carmel Valley. He did all the feasibility studies for all that land when there was land. And he basically told us at this group, there's no land left in San Diego, no big developable pieces of property that a builder could come in and build a lot of houses to increase the supply. So, there's just no land left. And San Diego is the most affordable coastal metropolitan city from here to Seattle. And again, like I said, it's pretty nice. Last time I checked here, and those people that are living in LA, San Francisco, even Orange County, are coming down here going, wow, it's nice. We want to come down here, and that's putting a lot of pressure on our market. And then with low inventory and high demand, we're seeing the prices are holding steady, or they're not dropping like people predicted they would, 6-7 months ago. The other thing that Gary London mentioned to us is that he's been doing this. He said, I'm not going to tell how old I am, but I will tell you I'm 7 recessions old. So he's been in the business about 30, 40 years. And he said, every time we have a recession, prices go down, our portfolios go down, some of ours anyways. Price of real estate tends to settle and drop a little bit. And every peak value in real estate has been increased by the next peak. So if your house is worth in 1997, peak value was, average value was 500,000. It might have gone down in late 90s, 2000 with the dot-com bubble crash, went down to average of 400. Like back up in 2005, it was right back up to a higher peak value than the previous peak. And he said that's been true for the last 7 recessions that he's been through. So while we hit a high peak here last July, where our average price of home in San Diego County was over $800,000, the predictability of it being a higher peak at some point when the peak arises again in the next, who knows when, it'll probably be at least that, if not higher. So what he was saying at the end of the day is people ask me every day, oh, should I buy a house? Should I buy real estate? Are the prices going to go down? My answer is, look, number one, San Diego's pretty nice, really nice. Number two, if you have if you're renting now, then yeah, and you're going to have a long-term view of buying a house, meaning you're going to live there for the next 3 to 5 years at least, then you're going to make money. I can't guarantee it, but you're going to get tax benefits by owning a home. You get the opportunity for appreciation by owning a home. You're locking in your mortgage payment by owning a home versus renting. And if you own a home, you can paint the house blue, red, black, pink, or green, and you can do whatever you want to it. When you rent from a landlord, you're helping your landlord build wealth, and you can't really do much to the house. It's his house, not your house. And we've seen many, many people the last year and a half get kicked out of their houses because their landlords are selling, or their landlords are, moving that money out. They need the money and they're selling, and now all of a sudden you've got impact on rental rates, and when rental rates have gone up significantly as well. So it's a tough housing market here in San Diego, but if you can afford it and get in, it's never a bad time to get in, I think, if you have a long enough time horizon.
So Scott, with that being said, we're about 30 minutes in here, and I told you I was only going to borrow you for 40. So I want to go ahead and open up. I opened up the chat as well. If anyone out there has a question, you're free to unmute yourself, or feel free to drop in the chat if you prefer. But I'm hoping there's a couple questions here for you while we have Scott. Keep an eye out here. Hey, there's Barbara. Hi, Barbara.
Hi, great to see you, and Scott, thank you for the nice presentation, and Ryan for those stimulating questions. I'm wondering, are there any investment opportunities in real estate here in San Diego, other than, let's say one owns a home already and doesn't want to be involved in trying to maintain another property? Are there any other kinds of ways to invest in real estate, either here or somewhere, that might be a good part of a portfolio?
So you mean as a passive investment where you don't have to actively manage a rental property?
I would think as a passive investment, preferably.
Okay. So yeah, I mean, I think I can speak to that a little bit, and Ryan can speak to that as well. So you can invest in real estate in a lot of different ways. Obviously, you can buy a rental property, actively manage it. Mm-hmm. You can buy if you have, or we work with people that also do syndications, where you can invest with a general partner who buys an apartment building. Mm-hmm. And gives you a return on your money. And then Ryan has, I'm sure there's REITs, real estate investments trust, which invest in real estate across the country, where you can direct your investments or a portion of your assets into investments like that are real estate related.
I think, more for what, Barbara, for what it sounds like, you're looking for something passive in San Diego. Mm-hmm. That would be more that along the lines of that syndication that Scott's talking about. And I'm sure Scott can put his email in there, and he could connect you with some of the people that actually put those syndications together. Scott, you have the chat up there by chance? Or actually, I could put your email up there.
I'll put it in there.
If not, okay, great. And then we have a question from Chris. I'm sorry, Barbara, did you have one more thing?
Oh, I just was wondering if you would comment about how you think a syndication kind of thing fits into an investment for a diversified investment portfolio. Ryan, do you have any
for me? Again, private real estate investing is not for the faint of heart, right? It's usually you have significant lockup times. It's not like investing in a publicly traded REIT where you have liquidity. Mm-hmm. So I think you just need to be aware of. You need to think of those type of investments in the context of liquidity, pricing, and what is the track record, and or how do you feel about the general partner, right? Because San Diego's long been known for being a hotspot for real estate. That also tends to attract people that maybe aren't of the quality of character that we would prefer for some of our investments. Mm-hmm. And so I think you really need to read either the prospectus or the offering memorandum, really vet the person you're working with. I think Scott probably be a better source of that, since we don't do any private. I mean, I obviously do private real estate investing on my own, as I own a home in Cardiff, but I don't do the syndication thing. And I would just be careful of where you go and understanding liquidity terms too, right? Because private real estate investing usually is going to have a significant lockup phase because they're investing it, like Scott has said, for the long term. And the general partner is going to require some type of, liquidity terms probably in excess of 5, maybe even 10 years. So I think you need to, look at all those different aspects. And I think Scott could probably be a good source of putting you in contact with some people that he knows, have the integrity that we would be looking for from the UCSD group. And I have a question from Chris about ADUs.
Yeah.
Do you have a record of the number of ADUs being built in San Diego County?
Chris, I don't have a record of it. I know there's a lot of them. I have I had a workshop also with a gal named Chris Dolnikowski, who has designed over 400 ADUs the last couple of years. And what she was telling us is that the state is mandated all the cities in California to create more housing, in addition to try to create more affordable housing. The city of San Diego, there's 22 municipalities within the county of San Diego. San Diego, San Marcos, Rancho Santa Fe, Chula Vista, those are all different municipalities, and they all have a different process for getting an ADU built. And what she told us is that the city of San Diego is one of the easiest and most progressive cities in the state for a homeowner wanting to build an ADU. And they've waived all their development fees for the moment to build an ADU. And they are trying to help people fast track plans and permits to build ADUs in their
more housing
properties to create more housing. We're seeing that an ADU is, again, they're building a lot of them. There's a lot of construction going on. And I don't know if that answers your question, but I can certainly give you more details on that. I've got a lot of information on that that's fresh because I had this workshop with this gal just a couple weeks ago. So.
Right. I don't see any more. I want to be respectful of Scott's time here. Thank you so much, Scott, for joining us and coming and offering your time to speak to our group here. Very, very much appreciated. If there's no more questions, everyone has the contact information, both Scott's direct line and his email address there. Scott's done, I think, 3 or 4 loans for me personally as well. So always had a great experience. He's got any great questions. He's also a great educator too. So if it's just questions you have, I'm sure he'd be more than happy to answer those. Scott, thank you again for joining us and spending an hour of your time with us. And Human, I guess we'll go ahead and sign off I'll stop the share here. And I guess we'll go ahead and sign off. And
let me just say,
have a great. Go ahead.
Thank you for being here today, all of you, and thank you, Ryan Human, for having me on the Zoom today.
Absolutely.
I appreciate the opportunity to continue to educate the community on building wealth of real estate. That's I love doing it. I've been doing it for a long time, and it's there's no dumb questions. We're here to help make sure that you're making the right decision for yourself and you're putting your best foot forward and going into any real estate investment you make, whether it's your house or a rental property or a syndication. Eyes wide open, you're pumped and excited to do it, and you have no reservations and no anxiety about it. So,
all right, everyone. Thank you so much. Thank you, Human, for having us today. Bye now. Take care, everyone.
Thank you for your time.